Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Upstart Holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. We have seen a really significant turnaround story emerge here. One that I think confirms Upstart's ability to navigate, the worst of that 2023-2024 credit cycle.
Right.
The focus is really all centered around the quarter that ended September 30, 2025. That was the moment the company moved from being a promise to a profitable operation.
That quarter was genuinely impressive, especially given how skeptical the macro environment has been for lenders. So let's start with the top line. What were the key numbers that signaled this big shift?
The growth metrics were exceptional, and it showed that the engine is fully firing again. We saw 71% year-over-year revenue growth.
71%.
Yeah, and you have to put that in perspective. I mean, many established financials are struggling just to hit double-digit growth right now.
Okay, so revenue is one thing, but what about the actual loan volume?
That was the real indicator.
Yeah.
80% year-over-year origination growth.
80%. So that means the volume of loans being issued through their platform, it basically doubled year over year.
It did.
That's huge. It proves that despite all the economic uncertainty, their funding partners, the banks, the credit unions, they're willing to jump back in and trust the model.
Exactly. It indicates a fundamental shift in trust. When rates were rising and the economy looked shaky, a lot of partners pulled back, their volume just collapsed. Now, the platform is demonstrating a performance and a scale that is bringing those partners back in droves. And that's what's driving that massive growth.
And crucially, the bottom line finally caught up. Because for the longest time, the story was, fantastic disruptive technology, but the financials were messy.
That narrative is officially dead. The biggest news was the concrete return to profitability. GAAP net income came in at $31.8 million for the quarter.
Okay.
Which translated to a diluted EPS of $0.23. And this isn't just a tiny profit, it's a crucial inflection point. It shows real operating leverage.
Meaning when they scale up, the profit scales even faster than the costs.
That's it. And the market's reaction suggested this momentum is, far from over.
Right, because management immediately raised guidance, didn't they?
They did. They didn't hesitate. They raised their forward revenue guidance for the full year 2025. This tells us two things. One, they expect Q4 to continue this pace. And two, they believe the funding environment is now structurally favorable enough to support this kind of rapid expansion into 2026.
So that's sustainability. That's the fundamental question now. Was Q3 a one-off, or is this momentum really baked into the system?
All the external signs point towards sustainability. When you look at the analyst community, consensus forecasts for 2026 EPS revisions, they've been moving steadily higher for the last 3 months.
So analysts are already pricing this in. They believe it's real.
They're not waiting, no. They're actively baking in continued profitability because they believe this inflection point is the real deal.
That leads us to the balance sheet. In fintech, resilience often comes down to cash. How does their foundation look after all that volatility?
It looks robust.
Yeah.
And that's a huge source of strength and confidence for partners. As of September 30, 2025, they reported a very healthy position, ample liquidity, modest debt. They are comfortably net cash positive.
So more cash than debt. Well, let's talk specifics. What kind of numbers are we talking about?
Cash and cash equivalents stood at $489.8 million.
Okay, nearly $500 million.
Right. And if you look at total stockholders' equity, that was $743.7 million. So these are not small figures. This cash buffer is essential.
And now that they're profitable, they're generating free cash flow, which is critical.
Yes, and that is so important right now. It fundamentally de-risks the enterprise and gives them flexibility. Well, strong free cash flow in 2026 gives management the ability to aggressively fund more growth, like the expansion into auto lending. But maybe more importantly, it offers a defense against their biggest risk, that funding reliance.
Right.
If the external funding spigot tightens a bit, they have $500 million in cash to weather that, or even step in to facilitate loan sales themselves.
Yeah. Okay, let's unpack this. What truly differentiates Upstart from a traditional lender or other fintechs? What's the secret sauce?
Their moat is deep, and it's all about technology. It's the AI-first lending platform. The ability to price credit risk with a granularity and an accuracy that the old FICO system just can't match.
So it's not just a better filter, it's fundamentally changing the pool of people who can even get a loan.
Precisely. They are identifying millions of creditworthy Americans, these thin-file borrowers, who would be automatically rejected by traditional models.
Yeah.
And they do this while achieving loss rates that are competitive with, or sometimes even better than, the banks.
So the AI's performance is the product.
It is. It automates, what, 75% of loans instantly? That's an efficiency no human lender can replicate.
And I imagine once a bank or a credit union integrates this system, it's pretty sticky. It's hard for them to leave.
Very hard. It's an embedded solution. Banks are favoring this because it gives them access to a wider customer pool and lets them manage risk in real time. This expansion into new credit products and top 20 lenders just solidifies their position.
And that expansion outside of personal loans is where the real scale comes from, right? Auto lending, mortgages, those are massive markets.
That's the long-term thesis. Personal loans proved the AI works. Auto lending, where risk is even more complex, and potentially home equity lines of credit, these dramatically expand their addressable market.
Okay, shifting gears, let's talk technicals. The stock's been a wild ride. What is the chart telling us right now?
The chart tells a story of stabilization after, well, capitulation. After the volatility in early 2025, we saw a critical base form in the $31 to $35 long-term demand zone.
So that looks like the floor.
It seems to be. It suggests that institutional money views the company as fundamentally undervalued below that level.
Okay, so we've established the floor. But what about the ceiling? Where is the stock trying to go now?
Since finding that base, it's been posting consistent higher lows, which is bullish. It's currently trying to break some intermediate resistance. The range we're watching is pretty tight, between $39 and $54.
And if it breaks above $54?
If it breaks decisively above $54, the next major resistance level is significantly higher, up around $70.
I noticed it's still trading below the 200-day exponential moving average, though. That's around $55.50. How important is that level?
That 200-day EMA at $55.56 is absolutely crucial. It's often the line in the sand between a bear market trend and a sustained bull trend.
So crossing that would be a huge technical signal.
A huge confirmation that the fundamental turnaround is translating into long-term price health. It could really accelerate momentum towards that $70 target.
And what about momentum? Is it running hot? Are we overbought?
Not at all. The RSI, the Relative Strength Index, is sitting right around 45. That's perfectly neutral. It suggests there's plenty of room for more buying to come in without triggering exhaustion signals.
And it's still volatile.
Oh, definitely. We have to stress that. Volatility is at 13.6%. High risk, but also high reward for those trading the catalysts.
Let's talk about those catalysts. The Q3 beat definitely shifted analyst sentiment. What are the price targets looking like?
The conviction has returned with force. After Q3, we saw a flurry of upgrades. Price targets are clustered in a wide but, very encouraging range from $63 up to $108.
Wow. And the consensus?
The current consensus price target is $78.83.
$78.83. That's nearly a 50% upside from where it was trading in late November. It seems like analysts are playing catch-up.
Precisely. They missed the inflection point. Now they're rapidly adjusting their models upward.
So what about the insiders? What is management doing with their own shares?
Insider activity has been pretty routine, mostly systematic. There was a minor filing correcting a gift of 750 shares, which just points to tighter compliance.
Okay.
But more importantly, we saw the chief legal officer exercising options and selling under a pre-established Rule 10b5-1 plan.
And for our listeners, that's different from just selling on the open market.
Right. A 10b5-1 plan is set up months in advance. It's essentially an automated pre-scheduled sale. So it's generally seen as routine portfolio management, not a lack of confidence.
Okay, so let's get into the near term. The next 3 months, what are the key events investors need to be watching?
The most critical event is the Q4 2025 earnings release. That's in early February 2026. This one needs to confirm the acceleration continues.
So if they post strong year-over-year growth again and give bullish guidance,
then the stock will likely confirm that breakout above $55.
what else could happen before then?
Partnership and vertical launches. There's a lot of market chatter suggesting announcements are imminent, maybe even before year-end, on full-scale expansion into auto lending and home equity lines of credit.
And that would be a massive boost to the long-term story.
Huge. It would prove their ability to scale the AI platform into these multi-billion-dollar markets.
We also have to watch out for broader market stuff, right?
Absolutely. Two things. First, market and index actions. ETF and S&P rebalancing in December can cause short-term volatility. And second, the credit health check in January. They usually release an update on holiday loan performance. That data gives us a great insight into consumer health and how well their AI models are performing under stress.
So what does this all mean? We've seen great growth, high targets. But what are the biggest factors that could derail this whole thing? Let's play devil's advocate.
We have to. Three key risks. The most critical one is funding reliance. Upstart is a marketplace. They rely heavily on their bank partners' appetite to fund loans.
So if credit markets tighten again, they're in trouble.
They are. If the Fed unexpectedly raises rates or something, origination growth could slow way down, no matter how good the AI is. They don't fully control the capital supply.
Okay, what's risk number two?
Model risk. The entire value proposition rests on their AI being superior. If the macro environment shifts and their loan losses start to tick up unexpectedly, partners could get nervous and churn. That challenges their whole competitive moat.
And the last one is just being in a tough neighborhood.
Exactly. Sector risk. Fintech is a high beta sector. It's volatile. External shocks, geopolitical events, they can cause sharp drops even if the company's fundamentals are strong. You have to be prepared for that ride.
Okay, let's synthesize this. Considering the risks and that spectacular Q3, what's the core investment thesis for looking at Upstart now?
The core rationale is a structural shift to profitability combined with disruptive tech. You have accelerating revenue, inflecting margins that prove operating leverage, and a clear competitive advantage with the AI platform.
And a huge runway for growth.
A huge runway with auto and HE-low OCs. The scale potential is vast.
So who is this for? Is it a short-term trade or a long-term hold?
It really appeals to two groups. First, the short-term, catalyst-driven trader. They're looking to capture that potential breakout above $55 heading into the Q4 earnings.
In the second group.
A long-term structural investor. This is the investor betting that the company becomes the dominant AI operating system for consumer lending, and they want to capture that massive scale over the next, say, 3 to 5 years. And here's a final thought for you to consider. Given the cash flows have stabilized and liquidity is approaching $500 million, we have seen, a trend of insider selling, even if it is routine. This stabilization raises an interesting question. Will management prioritize using that improving balance sheet to start a formal share buyback program in 2026? Such a move would signal tremendous confidence and could be a powerful new catalyst.
Capital allocation as the next big signal. That's a fascinating thought to end on. That's all the time we have for Upstart Holdings today. If you want more in-depth analyses like this, make sure you hit that subscribe button.